Yeah, first of all, thank you. Good morning, and thank you so much for taking the time out to attend this session. I'm not sure of the profile of the audience, so we have tried encompassing as much as possible so that you get an overall perspective on the taxation rules, the two different regimes, as well as how to approach the entire tax planning process. The objective of this is for you to understand the tax planning, the two different regimes, have a basic to slightly improved understanding of the different investment options available, and see what will work best for you given your goals, your financial goals, your risk appetite. So it has to be a holistic approach, and tax planning need not be looked at in isolation and as a last minute scrambling exercise. So we would be happy even if few of you take this particular message from after this webinar, have an adopt an holistic approach and use it as a tool to achieve your financial goals. So let me start it. So as mentioned, we will start with understanding of the old tax regime, understand how the current default tax regime, which many of us call it as a new tax regime, works, approach to planning your taxes, which is the most important, and when to choose what. Having said when to choose what, the most important thing is you should do your own calculation. Each one of us will have our own goals, our own commitments, our own salary structures. So for every individual it varies. Please don't generalize. However broad your understanding is, please check it out for yourself. We can also share the calculator, and there are plenty of calculators available online nowadays, so please invest the time to understand. So a few basic terms before we get into the entire exercise. And this is especially for those who are new to this tax filing process and or probably have joined the workforce very recently. What is a financial year? Financial year is the year in which earn your income. Deductions are the ones where investments that you actually make, which can be reduced from your gross taxable income. Assessment year is the one in which you actually pay taxes. Education cess of 4% has to be paid across, irrespective of the type of tax, it has to be paid across. Allowances can be paid as part of your salary, and there are several allowances which are tax deductible, so make use of it. Exemptions are the ones which is already a part of your salary, but you can remove a part of your income in order to reduce your net taxable component. Okay. So we'll first cover the old tax regime. Still, many of us are continuing to use this. This is the tax regime in which a lot of deductions and exemptions are available. Okay, so most of us are familiar with the tax slabs. We know that anybody with a gross income, even 1 rupee more than 2.5 lakhs in a year, is technically supposed to file their taxes. So up to 2.5 lakhs, you don't need to file your taxes, and it is 0%. If you fall in the 2 to 5% slab of net taxable income, you again don't have to pay taxes. You'll have to file your tax. You'll have to do tax filing, but you will not have any tax to pay, because you'll get a rebate of 12,500, which can be squared off against whatever. So the maximum is on 2,50,000, 5%, 12,500, you get a rebate, so it's zero. 2.5 to 5, if your income exceeds 5 lakhs, then whatever is the difference, you land up paying 5% on that. 5 to 10 lakhs is 20%, and about 10 lakhs is 30%. Now, surcharge rates, this is only applicable under the old and new tax regime if your if income is more than 50 lakhs. This is more for an information purpose. So, what are the different options available for claiming tax deductions and exemptions? There are plenty of options available. The most common ones are on your screen: ATC and their subsections. You have ATD and their subsections, ATG and their subsections. and ATTTA, TTB, ATU. So we have covered everything in the below slides. So we'll go ahead with it one by one. So investment options under section 80C. Why I have specifically mentioned this particular option is 80C gives you a plethora of avenues to make investments. Okay, so each avenue. So for example, ELSS, tax savings FD, EPF, VPF, NPS have carry a different returns profile, carry a different risk profile, carry a different lock-in profile. Given that each one of you are at a different stage in your life, or some of you may be in your 20 to 30s, no commitments, you still have a disposable income, you still can take a higher risk. Some of you may be in your 40s, the dynamics of your personal life changes. So each understand the features, characteristics of each of these avenues. It is very important. And once you get a hang of the lock-in and the returns profile, accordingly make a choice on what all you want to do. Most of us get EPF facility from our organization, so that is given. Besides that, you choose between a PPF, which has a 15-year lock-in, or an ELSS, which has only a 3-year lock-in. I'm just giving this as an example. If you take Employee Provident Fund, while it is the only instrument with EEE status, that is exempt from tax at all levels, it has a 15-year lock-in. You can redeem after 7 years, but ideally the lock-in period is 15 years. But it has the lowest risk. On the other hand, if you take a tax saver mutual fund, gives you the highest return but also has the highest risk. So the point that I'm trying to convey through this slide is each instrument has a different dynamics. Please understand that. We have come across many people, especially younger employees, who blindly get into insurance products just to make up for the ATC option. Please don't do that. There are plenty of options you can get into with keeping in mind your financial goals. So some of the things that I would like to specifically highlight is ELSS, or a tax saver mutual fund. It has the shortest lock-in, highest return and highest risk, good for young investors. Public Provident Fund, a must in as part of your overall portfolio, because it's only tax-free product, and we continue to believe that it will continue to be only the tax-free product. Must as a part of overall portfolio. Employee Provident Fund, please note that last in 2 years back, if your contribution, that is the employee contribution to EPF or Employee Provident Fund, exceeds 2.5 lakhs per annum, the interest on the additional sum, that is if you are contributing about 2.8 lakhs on 30,000, whatever interest you earn will now reflect in your AIS statement. It is a taxable component. So if your organization gives you the flexibility to restructure your salary, do so, and you could move to another investment avenue like NPS or some other option. Okay. National pension scheme, we are going to talk about it in detail, so I'll skip for now. Unit linked insurance plan, it's a very good option to combine insurance and investment, but please know that even in ULIP, whatever, if your yearly premium exceeds 2.5 lakhs from April 1st 2023, the maturity proceeds are now taxable. So Kanya Samriddhi, again a instrument which is giving you very good returns. Must if you have a girl child, open it before the child turns 10 years, and it's a very good maturity proceeds are tax free, handsome returns of 8% as on date. Life insurance policies, use this as a risk management tool. Please go in for a simple life cover, health cover. Health cover does not come in ATC, it comes in ATD, and we'll cover that later. Be careful before you take up any money back or an endowment policy, because the returns are very low. So don't blindly get into any insurance product, especially if you are young. Understand whether it's a pure insurance or something with catches behind it. So just be careful before you get into it. So again, my point that I'm trying to convey is understand each product and get into keep in mind your financial goals and accordingly get into the investment avenue. So we mentioned, see, this is one of the most important investment avenues that most people are getting into, NPS. NPS is important from two, three different points of view. One, it gives you a lot of flexibility in terms of where you can invest. Number one. Number two, increasingly, if there is some tweaking in terms of tax-free status or further benefits, we see that coming more in NPS because for the simple reason that NPS is a voluntary savings. You have to contribute to NPS. Of course, employer also contributes to NPS, but typically that will be part of your overall C2C. So because it's voluntary, there's a lot of demands to the government by PFRDA as well as other organizations saying that increase the tax benefits under NPS. So both as an investment avenue because it gives you the flexibility and seeing how the future could pan out because our NPS is a voluntary savings. Please, if you have not yet started, please look at NPS as one of the investment options. So NPS gives you three different sections under which you can save taxes. Number one is ATC, under ATC, it's actually ATCCD1, where you can invest up to 10% of your salary if you're working for the private sector, if you're a salaried person, and if you're self-employed, up to 20%. Okay. Besides this 1,50,000, it gives you an additional option to save, invest another 50,000 and claim tax benefits under Section 80 CCD 1B. The third option for you to save is if your employer is contributing to NPS, which as I just mentioned, that it will come as a part of your overall C2C, but still it's like an employee contribution, it does not come in your salary pay slip per se. Then you can claim 10% of basic plus DA. Most organizations also restrict the contribution to NPS only to this extent. So it gives you three different options to save taxes. This particular investment avenue. Please know that when there is an employer contribution to NPS, that is also allowed under the new tax regime and not only under the old tax regime. Okay, so only tier 1 account is eligible for tax deduction. Tier 2 is just like any other mutual fund account. You can open it. Once you open the tier 1 account, you can put in money, withdraw anytime. The rules are a lot more flexible and free, but you will not get any tax benefit for what you put into tier 2. If you choose the auto option, you have two different options. If you're a passive investor and say that I really don't know anything about this, I trust the fund manager, you can go in for an auto option which is age based, and they give you three styles: aggressive, moderate and conservative, where the equity percentage would vary and change. You can so you can choose which particular do you want to. If you're an aggressive investor, if you're somebody who can take more risk, go for the aggressive option. Or if you're somebody who can take, who does not have that higher risk appetite, go for the conservative option. If you opt for the active option, you can choose allocation between the four different investment avenues that NPS offers. They are Scheme E, Scheme C, Scheme G, and Scheme A. Scheme E is equity, Scheme C is corporate bonds, Scheme G is government securities, and A is alternative investments. Okay, so I've mentioned here the a maximum limit up to which you can do. Private sector only can invest in Scheme A, which is alternative funds, and only up to a maximum of 5%. Please note that government employees are not allowed to. Okay, you can switch between the fund manager in a particular year once, and you can switch between auto and active option 4 times in a year. For government employees, it's twice. So there are many variants of an NPS withdrawal rules, NPS withdrawal on retirement, on partial withdrawal or premature exit. I'll just cover the main important ones because otherwise we will be going too much into detail. If you have any specific questions, you can ask me. I'll clarify it during the chat session. So on retirement, the rule says that 60% can be taken as lump sum and it is tax free. 40% is also tax free provided you reinvest it into annuities. Okay, so 100% is tax free, out of which 40% of the proceeds has to be reinvested into annuities.
Okay, so the same rule applies for government employees also. If you take an early retirement, please note that you should have been invested into NPS at least for 5 years, and you will get only 80% has to be reinvested into annuities, and 20% can be taken as lump sum. The same rule again applies to the government sector. One point that I missed mentioning is, on retirement, if you're taking NPS, if your accumulated corpus is less than 5 lakhs, you get the entire amount as one lump sum tax free amount, and that is, you don't need to reinvest it into annuities. In case of early retirement, the same number translates to 2.5 lakhs. On death, the for a private sector employee, the entire amount is given off to the legal heirs, and they can decide whether they want to convert it into annuities or not. For a government employee, you if the corpus is less than 5 lakhs, the entire amount is given away. If it is more than 5 lakhs, 80% has to be converted into annuities, and 20% will be taken as provided as lump sum. So these are NPS partial withdrawal rules. Under you can there's no restriction for withdrawal under Tier 2 corpus, but under Tier 1 corpus, under these conditions like critical illness, higher education, or children's marriage, you are allowed to withdraw, but only 25% of the corpus. Okay, and there can be only 3 such withdrawals, and there should be a gap of at least 5 years between each withdrawal. So there are a lot of restrictions when while taking money out from NPS, which is actually good in the long runs because we will also plan better. I've just put in NPS premature exit. If you don't want to continue with NPS, how you can go about it, but you should have been invested for at least 10 years. If your corpus is more than 1 lakh, only 20% is again given as lump sum, 80% has to. So there are many rules to NPS. Due to limitation of time, we cannot get into too many details, but do look up. NPS is a very flexible investment avenue, a must have given the way things are changing in terms of tax benefits that the government is giving. So please look at this option. NPS is voluntary, and increasingly, if there are some tweaking, I'm repeating, we think that it will happen only on the NPS front. It's most of us are already into EPF, Employee Provident Fund. So this is also an important to understand that EPF also gives you different options for withdrawal. We contribute, most of us contribute 12%, and the employer contributes an equal share. So these are some of the reasons under which you can withdraw money. I had shown a slide where we mentioned the risk profile, returns profile, and lock-in. This is very important to understand before you get in, because it will decide how you plan out the other investments, how you manage your entire money. So EPF also gives you these benefits. Please understand the benefits, and you can utilize this particular savings when there is a necessity. So you can use for your children's education, provided you've completed 7 years and the child has completed class 10. So 50% of the employees contribution, please note, it is only employees and not employer and employee. So you can take up to 50% of the employees contribution. Medical emergencies, typically they don't ask, but it as per the rules, it's 6 months of basic plus DA or employer contribution along with the interest, lower of the two. Repayment of home loans, you should have been invested at least for 10 years, and 36 months of employer and employee contribution along with interest. So even EPF gives you several options for withdrawal. Please have an understanding of this, and these withdrawals are tax free provided you have been into this particular investment avenue continuous service for at least 5 years. Okay, now we completed the ATC part. Let us go to some other important sections which most of us typically use. Coming to the first, exemption. This is not a deduction, this is an exemption. Many of us get house rent allowance as part of our salary structure. So those who are paying a rent can claim a deduction against this particular house rent allowance. So I've given the working on how it works. So it's basically, if you're getting 100 rupees, you can, from this 100 rupees as house rent allowance, you can, from this 100 rupees, remove the lowest of the three, either your 40% of your basic, or rent paid in excess of 10% of your basic, or the actual HRA receipt. Whatever is the lowest number can be removed. If it's 20 rupees, you remove 20 rupees and only 80 rupees gets taxable. Okay. So you have, you can go online to check how much is your exemption limit. There are plenty of calculators available. There are two, three doubts that people typically ask us when we conduct webinars on taxation, and especially with HRA. One, if I'm also paying rent for my parents, can I claim? No, you cannot. You can claim only where you have a residential accommodation. That is, if you're living in that house and you're paying a rent, then you can claim HRA. Okay. The second thing is, when you live with your parents, can I claim HRA? Yes, you can claim HRA when you're living with your parents, but please make sure you have some kind of a formal agreement. There is proof that you're paying rent to your parents. In case you're questioned, you may have to show the bank receipt, bank transfer proof, and the house should be owned by any one of the parent. Okay, you cannot be a co-owner. Make sure you have some simple agreement just as a backup. There are some instances when, can I claim both HRA as well as deductions towards home loan and principal? Yes, especially if you're in two different cities. Even if you're in the same city, if the reasons are genuine, you can do that. Okay. There are TDS on rent paid. This is important, especially if your owner is an NRI. Just take cognizance of this. We will not get into too many details. If you're a resident Indian and if your rent per month exceeds 50,000 as per section 194 1B, you have to deduct TDS. And for TDS, as a taxpayer, you have to take a TAN number, deposit the TDS, and only then pay the balance rent to the owner. This is a very important rule. Please try understanding this, especially if your owner is an NRI. If it's an NRI, it's a flat 30%. It does not matter what the rent is. So please take cognizance of this particular thing. And if you're if the owner is a resident Indian, if you are paying a rent of more than 50,000 per month, you definitely have to deduct TDS. For resident Indian owner, it is 5%. NRI, it is 30%. Please note, the onus is on the taxpayer to deduct this TDS and not on the owner of the property. So you have to deduct and then deposit the remaining rent with the owner. The next popular exemption or allowance that you get is leave travel allowance. Not many of us utilize this fully. So how does leave travel allowance work? So the government declares block of 4 years. Okay, the current block is ends on 31st December 2025. It started in on 1st January 2022. So you can use leave travel allowance for any two trips in 2 out of the 4 years. Okay. Only domestic travel is allowed. The travel should be by air, train, or bus, and to and fro cost. You cannot claim lodging, eating expenses, only travel expenses. In case you're using a personal car to go to the same destination, that can be claimed. You can claim the fuel and toll charges. So a lot of them ask me, so if I keep traveling to my hometown and I use my personal car, can I plan it in such a way? Yes, you can, but for two trips and in 2 out of 4 years. Okay, maximum of two trips. So please utilize this. Most of us go on vacations. You can use it for your spouse, children, parents, and dependent siblings. You can get the entire leave travel allowance as an exemption if you plan it properly. Practically all of us go on vacation, so utilize this particular allowance. The next is deduction, most one of the most popular benefits that we get. Please note, under section ETC, up to a limit of 1.5 lakhs, you can claim the entire home loan principal. Your banker gives you how much principal, how much interest is deducted every year. You can take a statement from them. And under section 24B, you can claim up to 2 lakhs of interest. So please, you can claim the rules 2019. You can claim interest and principal deduction for two properties also. provided it is within the limit. When I say it is within the limit, ATC should be only 1,50,000, 24B interest part should be only 2 lakhs. Okay. It is good if you and your spouse both are working, take it in a joint name so that both of you can claim tax benefits on it. For an under construction property, you cannot claim principal or interest, but the interest component, once you get possession, can be claimed over 5 equal installments. Okay. But the rule also says that you should not be selling the property within 5 years of possession. So keep note of all this. Under construction, no principal, no interest deduction, but post possession, only the interest can be claimed, the pre EMI interest over 5 equal installments, provided it falls within the overall 2 lakhs limit. Another popular section is the ATD sections. We all know you can claim medical insurance under ATD. Simple rules for this. If you are below 60, it is 25,000. If your parents are also below 60, so 25 per 25, max of 50,000 can be claimed. For those between 60, above 60, you can claim up to 50,000. So typically most of us fall into the 75,000 maximum limit range, where we are under 60 and parents are above 60. So you can claim up to 75,000 under ATD. There are some subsections ATDD where when you spend on dependent disabled dependent, if the disability is between 40 and 80%, you can claim an exemption of up to 75,000. Above 80%, up to 1,25,000. Similarly, ATU is, yeah, you have a disability. Depending on the degree of disability, you can claim from up to 75,000 or up to 1,25,000. So just go through these sections in case you are not availing them. So we finished broadly the main salary part, the provisions, popular provisions that one can avail from the salary part. There are a few which we have missed out. In case you have not missed out, we are not getting into too much detail like ATGG. So even if you don't get rent, you can claim up to 5,000 as deduction towards rental income. Then you have what you give charity. So there are many other sections which we have not covered. If you have specific questions, please put it. Other heads of income are income from house property, business or profession, capital gains, and income from other sources. We are going into the details of it. So, income from house property, you can either take self-occupied or the let-out property. For these are the steps that how you compute your income from net income from house property. Please note this is exactly where you will be deducting the interest from on that you pay on the home loan. So the first step is determine the gross annual value of the property, reduce the property tax that you have paid, and you'll get a net asset value. From the net asset value, you're allowed 30% as standard deduction. Deduct your home loan interest, and the remaining is your income from house property. So when you typically reduce your income interest part from your house property, it will come as a negative figure. So that can be removed from your gross taxable income. Please note that the gross annual value for a self-occupied property will be 0, and you can show up to 2 houses. And for a rented property, it's the rent that you receive as income. Okay. So these are the main things that you need to keep in mind on for income from house property. There are two sections, 80EE and 80EEA. This is just in case you are not availing it. For people, for first time home buyers who availed a loan between 1st April 2016 to 2017, besides this 2 lakhs, you can claim an additional 50,000 as deduction towards interest. Similarly, the government in 2019 introduced an 19 budget introduced Section 80 EEA. Again, if you're a first-time buyer, you can claim an additional 1.5 lakhs as interest deduction, provided the loan availed is between April 1st, 2019 and 31st March and 2022, and the house value should be less than 65 lakhs. Okay, so it has to be a first-time buyer, and the loan should have been sanctioned between this particular time period, and the property value should be between 50 lakhs for, which should be less than 50 lakhs for Section 80EE and less than 65 lakhs for Section 80EEA. So if you fall into that category, you can avail this benefit. Okay. Income from capital gains. Nowadays, most of us invest into mutual funds, stocks, ETFs, and debt products, gold, property. So these are the rules that one needs to keep in mind. So for equities, if you've held the equities include stocks, mutual funds, and all that. So if you've held for more than a year, you will have to pay 10% on capital gains above 1 lakh. So if you are holding mutual funds for 5 lakhs and you happen to sell for 2.5 lakhs, the gains on that, assuming it came to about 1 lakh 10,000, and it is all long term, that is, you've been holding it for over a year, you have to pay tax of only on that 10,000 over and above that 1 lakh, so 1,000 rupees, just as an example. If you held any of these instruments, stocks, mutual funds, equities, any equity instrument for less than 1 year, it is a rate of 15%. Here, missed mentioning, for unlisted equities, the long term is greater than 2 years and short term is less than 2 years. For debt products, please note that there was a change in the tax rules starting April 1st last year. It was announced in last year's budget. So from April 1st, 2023, all the gains that you have in debt and fixed income products will just be added to your remaining income, and you will be taxed at the marginal tax slab. Okay. But if you have purchased any debt fixed income product like a debt mutual fund prior to April 1st, 2023, and if you were holding it for more than 3 years, you get the tax rate, it would be considered long term, and you would get a 20% tax rate with indexation benefit. If you are not claiming indexation benefit, it is a flat 10%. If you have any specific questions, ask. It may, if someone is new to it, it may seem confusing, but these are very simple rules, or you could even write to us and we will clarify it. So for debt, if there is a slight change in rule depending on when you have purchased that particular debt mutual fund, so take cognizance of that. The similar is for gold, international funds, fund of funds. The rule has been changed since last year's budget. Now, many of us incur long-term and short-term capital losses while we are selling our mutual funds and stocks. If it's a long-term gain, that is, if it is of gains because you held the units for more than a year, you can square it off only. If it's a long-term loss, you can square it off only against long-term gains, or you can carry forward it for the next 8 assessment years. If it's a short-term capital loss, you can square it off against both long-term as well as short-term. Uh, One quick peek into ESOPs and RSUs. Most of us work in organizations which provide this particular benefit. So, what are they? How are ESOPs taxed? Both ESOPs and RSUs are taxed as perquisites. When are they taxed? ESOPs is taxed when the employee exercises the ESOP. So, suppose you were vested with ESOPs, 100 ESOPs at the rate of 10 rupees. And today the fair market value is 150. So you pay 100 into 10,000 rupees. If the current market value is 1,500, so on the difference 500 rupees, you'll be paying a perquisite tax of 30%. Okay. Similar, RSUs is given free of cost to the employees after the vesting period. So it is taxed completely on the day it is credited to the employee. So similar example, if you're given 1,000 shares at 10 rupees, fair market value is 1,500, you are credited with 1,500 shares, you credited with 10 shares with the equivalent value is 1,500, so that will be taxed at the perquisite tax rate of 30%. It's a fringe benefit. Okay, so what is tax? Market value less purchase price. So in the case of an ESOP, the market value is the prevailing price. For an RSU, if fair market value is not zero, I'm sorry, I stand corrected here. Your purchase price is zero. So whatever is the fair market value, you will be taxed on that. Yeah. The next thing we go to is income from other sources. Whatever does not fall in the other heads, income from house, property, business or profession, everything will come under income from other sources. It's primarily your interest income that you earn on savings bank or FD or other fixed income products. So these are the options. In case there's a prize money, or you won something through game shows or puzzles, the tax rate is a flat 30%. Okay. Dividend income also comes as income from other sources. Nowadays, all this gets reflected in your AIS statement. If the dividend from any one particular entity exceeds 5,000 rupees, you have to deduct TDS. Okay, that will anyway get reflected in your AS 26. So there are two important sections when you speak of income from other sources. One is section 80 TTA, where for interest that you earn on savings bank up to 10,000, you can claim as exemptions. Senior citizens can claim 80 TTB for interest on fixed deposits up to a maximum limit of 50,000. So many of them who don't fall into the taxable bracket, you have to inform your bank that you do not have to, the TDS should not be deducted. So it is mandatory for you to either submit 15G if you're under 60 years, or 15H for senior citizens at the beginning of the year itself, and this has to be submitted every year. So keep note of these small rules so that you can avoid taxes. Income from business or profession, many of us have double income. We have a salaried income as well as we some business or profession. So we'll first cover the business part. If your business, you'll first have to select the type of ownership. Please note that you will have to manage books of accounts if your revenues are more than 25 lakhs in any one of the immediate preceding 3 years, or even in the first year. If your business income exceeds turnover is more than 1 crore, or if your income is more than 2,50,000, you have to do a tax audit. Similarly, for professionals also, professionals could include doctor, engineers, interior designers, so on and so forth. It's a big list. So those who are considered as professionals, if your gross receipts exceeds 1.5 lakhs in any one of the years, in the first year or any one of the 3 preceding years, you have to maintain books of accounts. And if your income in gross receipts exceeds 50 lakhs, you will have to do a tax audit too. Similar rule for freelancers. Now the context for business or professionals is comes there's something called presumptive taxation, where you can avoid maintaining books of accounts and just show a presumptive income. So when I say it's presumptive income, the rule says that if you're a small business owner, and if your receipts are up to 2 crores, and if the receipts are all online, then the limit has been increased to 3 crores in the last year's budget. Similarly, for professionals, if your income receipts are up to 50 lakhs, and if it's all online, the limit has been increased to 75 lakhs. You can adopt presumptive taxation. What does presumptive taxation mean? That means it's for a business owner can say that most of my I will pay only 8% as for non-digital transactions and 6% for digital transactions, and that will be taken as the income, okay, as the taxable component. Similarly, for professionals, if you are allowed a 50% deduction directly. So if you're earning 50 lakhs, you have to pay income only on the balance 25 lakhs. But please note, if you're a professional, like if you're a doctor, you can claim, and you're earning about 50 lakhs, you can claim deduction of 50% directly, and only on the balance will be taken to your you'll have to pay at your marginal tax slab rate, that is the tax slab rate at which you are currently in. So many of them who do not wish to maintain books of accounts or have their tax audit, and whose income or gross receipts do not exceed this level, go in for presumptive taxation. Especially if you have a salary income and you're also earning through this particular source, please adopt presumptive taxation. You can save a lot by way of taxes, and it also makes your entire tax filing process easier. Yeah, so with this we come to the end, broadly come to covered most of the things from the old tax regime. We'll come to the new tax regime, or the current tax regime right now. And yeah, so this will get over much faster because we don't have too many deductions, we don't have too many exemptions. So we will cover this part quickly. So what is the new tax regime? It is important to understand why the government introduced this 2-3 years back. and modified it last year. So this thinking is not new. It's been going on for over last 10 years. It has been proven through a famous economic theory called Laffer's curve that when you simplify the tax regime, the tax slab also increases. Also, the intent is to bring many more into the tax net and make it easier for people in the lower salary slabs of income. Okay, so the intent behind of the government was to simplify the tax structure, make bring in more into the tax net, and reduce tax outgo for people in the lower slabs. So these are the rates for the new tax regime. It is also the default tax regime. So there is an underlying message that when government is saying that this will be the default tax regime, it also means that if there is any tweaking, any changes that are going to happen, you can expect it to happen in this tax regime more than the old one. Okay, so and we'll also see many people adopting this particular tax regime increasingly. So these are the tax slab, very simple. Up to 3 lakhs, no income tax. 3 to 6 is 5%. 6 to 9, at every additional 3 lakhs, it increases by 5%. The big benefit that the new tax regime is giving is that you get standard deduction of 50,000 even here. Okay. The for people in the above 5 crore category, their surcharge has been significantly reduced, which is a big benefit. So when this tax regime was announced, we came across many media messages saying that up to 7,50,000, you don't have to pay any tax. How does this work? Very simple calculation. So this is how it is. So taxable income before standard deduction, assuming you earn 7.5 lakhs. After standard deduction, it comes to about 7 lakhs. So if you compute the tax for a 7 lakh income, it comes to about 25,000. Under the new tax regime, for up to 7 lakhs of net taxable income, you get a rebate of 25,000. So your tax liability is zero. So those who are in this particular income range very safely go for the new tax regime. If your income is up to 7.5 lakhs, very safely go for the new tax regime. One more important thing is this rebate is available only for a resident individual. There are a few deductions available in the new regime or the default regime. These are the ones. Noteworthy ones are interest on home loan on let out property. That is, if you let out the property, you can claim interest under Section 24B. Employee contribution to NPS, we mentioned this in an earlier slide too. And leave encashment, the limit has been increased from 3 lakhs to 25 lakhs. So these are some additional benefits that the new tax regime gives. It's not that nothing is allowed. Yeah, so because there are not many exemptions, we finished the new tax regime features very quickly. So now we are coming to the most important part from an individual's point of view. What should be my approach when I'm doing tax planning or financial planning? So first and foremost is, see, there is no substitute for to asset allocation and discipline. We have been in this domain for over last 25 years and met several clients of different profile, people who have managed to meet their financial goals. These are the only two things that has helped them: the right asset allocation, or managing their asset allocation based on their age and risk profile, and two, discipline in investing. So be it tax, you look at tax as an avenue to meet your financial goals too. The second point that I would like to mention here is insurance is one of the options or investment avenues many of us use to cover ATC. We take a life cover or probably a money back policy. We have come across many clients who have multiple endowment, multiple money back policies. I had mentioned that it is very important to understand your returns profile, risk profile, and lock in period for every investment avenues. If you go in for a money back policy, typically people pay for 15 years, 20 years. There is a much higher lock in, and you earn only 5%, 6%. This could be a category which can afford to take a slightly higher risk and probably invest into an ELSS. So when you're using insurance as a tax planning option, use it for a simple life cover or for your health cover under ETC and ATD. try not combining insurance and investment is the underlying message. So be careful, use it for your risk management and tax planning, and not as an investment avenue for a very long time period. So the third thing, very important, is tax planning can also be goal based. Whether, irrespective of the stage you are in your life, you may be in your 20s, early 20s, mid 20s, early 30s, early 40s, whatever, all of us will definitely have one goal, and that in all probability is the retirement goal. Okay, maybe the others could be different for each individual. Some may be married, some may not be married, some, for some it's vacation, for some it's entrepreneurship, but retirement is probably a goal which most of us can put a timeline to. So at least start with that goal. So that will give you a sense of clarity and perspective. Should I be in my EPF? Should I start NPS? Should I do a PPF? So these are avenues which silently help you build a corpus over a very long time period. So tax planning is not just to do away with the tax. Don't take a short term approach, is what I'm trying to tell you. Let it be a long term approach and combine it with the financial planning. Financial planning is your risk management, which means you should have an emergency corpus, you should have health cover, life cover, and at the same time you should have enough corpus to meet all your goals. So look at tax planning also from a long-term financial goals point of view. ELSS, I'll give a simple example of ELSS for my client. So this particular client started ELSS sometime in 2006 and continued till 2019. Then they moved to the US, they stopped it just by doing 6,000 every month and continuing it till 2019. Today they have they didn't stop in between any time. They've not taken out any money. Today the corpus is close to about 2021 to 20.5 lakhs. So even a simple instrument like ELSS will give you the liquidity, will give you the avenue to save for a goal. So understand your financial goals and accordingly plan your investments. Be very mindful before you withdraw from EPF and NPS for goals other than retirement. Remember, we will not compromise on your children's education goals or a house purchase goal, but where people typically tend to compromise, especially people in their 40s and 50s, is their retirement. So when before withdrawing money for any other goal like children's marriage or education, be mindful of how much you're doing it and how it's going to impact your other financial goals. The final point that I would like to make is tax planning need not be a scrambling issue in the last minute. Okay, all these, most of the investment avenues, be it an ELSS, NPS, EPF is anyway done monthly, PPF, it can all be done as an SIP mode. We don't need to do it in the last minute. So it takes probably 1 or 2 days of planning at the beginning of the year. Set up everything as an SIP mode so that the money goes silently. You also don't realize it, and you plan your remaining expenses accordingly. So SIP mode is not just restricted to mutual funds. You can do it for practically your life insurance premiums, your health insurance premiums. Everything can be done in an SIP mode. So please explore that option. NPS can be done in an SIP mode. So explore that option and plan your money appropriately. So this is a quick checklist on what is available for what are the exemptions. We have taken this from another website, so but it's very useful. Please have a look at it on the what is available in the old regime and what is not available in the new regime. It's more of a quick checklist. So when do I choose old regime and when do I choose new regime? So choose old regime only if you are able to manage this kind of deduction. Sorry, because of the initial inconvenience, we are not able to show you some live examples which we had kept ready. But if somebody is interested, please write to us and we will share it. We will also share the calculator. So if your income is between 8 lakhs and 9 lakhs, just as an example, if you have not managed and deductions plus exemptions, that is ETC, ATC, CD1 or some other exemptions, everything put together of at least 2,12,500, please go in for the new regime. Similarly, for someone in the 12 lakh 50,000 to 15 lakh bracket, if you have not been able to manage at least 3 lakh 58,000 of deductions and exemptions, please go in for the new regime. Having said this, this is a good checklist. You can just have a look, understand this, but also do the calculation yourself. So this particular chart also is very useful. It gives you your gross income and the different levels of deduction at which a particular regime may work better for you. So have a look at this also in detail. So that brings us to the end of the tax planning. I would just like to reiterate a few points again. Don't look at tax planning as a yearly exercise. Please look at it holistically from a financial planning approach. It really helps. We have seen it with our own clients where it has helped them meet their financial goals by just continuing with the investments and doing it in a systematic way. So you can do it in an SIP mode, understand the features of every product that you're getting into, and accordingly understand their lock-in, their risk return profile, and accordingly get it. So hope this session was useful. Very quickly about Right Horizons. We are a 20-year-old firm headquartered in Bangalore. We have 6 other branches in key location cities like Mumbai, Delhi, Pune, Chennai, Kolkata. It's a 60-member team. We manage approximately about 2,500 crores plus. Our main expertise is on the financial planning and portfolio management services front, and we are SEBI certified for all the services that we provide. Our team of investment advisors also have the necessary certifications prior to getting into the advisory domain. So these are my credentials, and if I'm open to questions, if there's anything that you would like to ask, happy to take them. Just a second. Where is it? Yeah, I'll just take the questions once again. Chat is just a second.
हाँ जैसे इसको इधर इधर उसको क्लिक करके नहीं करूँगा तो भी यहाँ से कर सकते हैं।
Yeah.
ये जब वो एक Q&A है, ठीक है?
Yeah. Sorry, I'll just go through the questions. Can I claim 80 EEA while filing ITR? Yes, you can claim, provided you've taken. Yeah, Mike. You can claim, provided you have taken the loan during the specified time period, and the property value falls within the limits. You can claim. I don't think you can do it retrospectively, but you can claim for the next assessment year. Just a second. Yeah, just a second. How long can we continue the EPF post retirement and still getting the interest? You have to make. I think you have to declare that you will be continuing with the EPF. It's you can. There is some simple form that you need to submit, and your organization also needs to submit. You can continue till the actual age of retirement. We know many who are doing it, who continue working till the age of 65, who start getting the pension part, but they can continue to make the contribution towards the provident fund part. Okay, but there is I think you need to inform them through filing of a simple form. Just a second. What is the exemption limit for education loan repayment? You can claim the principal part, but the interest can be claimed that there is a person who's repaying the loan. The interest can be claimed for 8 years. Okay, there is no restriction on the amount of interest, but interest component can be claimed, not the principal component. How do you deal with? No, you cannot deal. How do you deal with income from options and futures? Can we use presumptive clauses for this? No, presumptive income is not applicable for options and futures. It will come under your normal capital gains taxes. You cannot use presumptive income for this. Um, I had taken health checkup of 5,000 additional to 25,000 in ATD. No. This 5,000 additional health checkup is included in 25,000. So suppose you incur 22,000 of health check of medical insurance premium, you can claim an additional 3,000 towards annual health checkup. It is not 22 plus 5, it is 22 plus 3. So within the limit of 25,000, you can claim the health checkup sum also. So it is not total up to the limit of 25,000. What is the tax rate for dividend amount? Dividend amount is just added to your income, and whatever is your marginal tax slab, that is your current tax slab, it is taken at that. The TDS of 5% is deducted if your dividend income from a particular entity crosses 5,000. So there is no special rate for dividend income. It's just added to your tax slab. If property is joint owner with wife, can we claim rent of income? For wife only, yes, you can claim rent income of wife. Uh, See, the rules are very simple, actually, straightforward. You can claim, you can make sure that the rental income goes to her. But even if she is earning more than 2,50,000 and she's in the old regime, or she's earning more than 7 lakhs and she's under the new regime, she'll have to file taxes. You'll have to file taxes if your old regime more than 2,50,000 and 3 lakhs under the new regime. So income can go to anybody. Whether they pay taxes, they fall under the taxable net or not, is another story. But they have to pay taxes. They will. You can take it in whosever name. So that's not an issue. If my kid is staying in hostel, can we claim this in HRA? No, you cannot claim this in HRA. HRA is only for where you are technically, as per rules, it is residential accommodation. You cannot claim this in HRA. Um, do you recommend having? Do you recommend to have term insurance after retirement, post your salary income stops? This is a very good question, and we are faced with this practically every day. See, there are two ways to look at it. Many of them go in for a life cover till they are 85 or so. This is especially in case their children have, there are still some goals that you need to meet with respect to your children. It could be their marriage, it could be their some other education, or some other expenditure. So in that case, if you probably, if you have had late kids or something, continue with the life cover. Technically, the purpose of a life cover is to compensate for loss of income. Okay, so you can go, if you have managed to build that kind of a corpus, if you think you will manage to build that kind of a corpus and you'll be meeting all your goals by the time you're 60, you can go only till 60 years. That is only till you earn a regular income. But if you still think that I either need to leave a legacy after, if something happens to me, or if many of my goals are still unmet, have not been fulfilled, then continue for a longer term life cover. What you could probably do is, you can pay off all your premiums in your earning period. That is till you're 60, you can complete payment of all premiums and just keep the policy active. So you will have a cover anyway till 85. So many of them do that. They pay off all the premiums till by the time they're 60, and ensure that they have the life cover for a longer time period. Is it worth discussing old tax regime, as it will be obsolete in near future? I don't think it will be obsolete. It may remain the way it is. It is worth discussing for the simple reason that still people who have a home loan principal, and who can manage reductions up to 3,75,000 or so, and in a higher tax bracket, old regime still works better. And old regime is also good from another point of view. Old regime of provides you many investment avenues through which you silently build a corpus, which is very, very important. We undermine the importance of EPF, PPF, NPS. So these are investment avenues done in a, however small the amount. Maybe just put 1,000 rupees into PPF every month, or put 1,000 rupees into NPF. The kind of corpus, especially for someone in their early 20s, the kind of corpus you'll manage to build by the time you're 50, 60 is really impressive, provided you don't take it out. So, old regime has a lot of benefits. They've made it complicated because the plethora of investment avenues are so large. So that's why it seems complicated. But it's a old regime gives you beautiful avenues to live a life where you can where you can achieve financial freedom. But your point is well taken. I won't call it obsolete, but new tax regime is where a lot of the tweaking will done. Will the old tax regime stop moving ahead? I've answered this question. We don't think it'll stop, but the tweaking or changes, whatever benefits you see, will happen only in the new tax regime. um, okay. Yeah. Yeah, so I will just take one more question and then we'll end the session. Just a second. Just yeah, about the interest to be, I'll just take this one last question on interest loan. If there's anything else, you could write to us and we will ensure we answer them. About the interest to be claimed over 5 years, can we claim the interest of 2 lakhs multiplied by 5 years? By no, 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 not like that. Suppose it is 2020, you bought the house and you get a possession in 2025. The total interest that you have paid in the before possession works out to about 1 lakh. Just a random example, 1 lakh. You can claim 20,000 every year from 2025 onwards over the next 5 years. So it is not the total amount, it is what you have actually paid.